Welcome to the Daily Brief, where we'll go over the action in the market for Friday, March 17th, and then we'll see how things look for Monday, March 20th. We had just as much of a down day, almost, as we had an up day on Thursday, so a lot of the positive backdrop that we started to see being developed after Thursday's session, it pretty much went away in Friday's session. The one consolation is we're not really extreme overbought or oversold right now with any of our indicators. There's one indicator that I'll show you. For the most part, we've worked off that situation, but now we're strictly in a downtrend with more room to fall if the market decides to do that. So let's go back and talk about what happened. Right at the open, we had a lower open, not a real gap, with prices dropping below the 200-day simple moving average, so that's more negative. At 39.37, it also fell below the daily pivot at 39.30. We found support at just about the 39.10 level and then tried to bounce up off of that, but we really didn't do a very good job. As the day went on, prices then just chopped between 39.01 and the daily pivot, and we closed a bit off of the low. So we ended up being down 1.1% on above average volume. Now this was quadruple witching. I think I said it was triple witching last time, but now that's been changed to quadruple witching. The technicals are negative overall. The market's still fixated on inflation and interest rates, and the banking situation seems to have come back in, at least to concern the market as of late. Here's the intraday chart showing how we had a lower open, quickly went down below the 200-day simple moving average and down below the daily pivot. We came down to this 39.10 level-ish or so, just a little above 3900. Bounced up off of that, could not break back through the daily pivot, came back down, went up slightly, but then closed a little bit off of the low for the session. Looking at the action between value and growth, the blue line is growth, and it did better in Friday's session than value did. Both were down overall, but growth ended up performing better. Value really got hit in Friday's session. For the large cap value, they were down 1.62%, where growth was down 0.77%. And even with the mid caps and the small caps, the growth did a little bit better. Then here's the intraday chart showing the SPY. The futures were up during the night, but then started to drift down lower. And then as we got into the overnight session, that's when things went more negative. We tried to bounce up off of that right after the open, but then took things down lower. What are some comments that we can make? We had quadruple witching, and that can make for kind of a crazy day because you have all these strike prices in play. You have people buying, selling, not only options, but also individual securities and indexes. The conclusion that we can make based on the upward move that we saw on Thursday was that yesterday's relief rally was short-lived. We gave all of that back pretty much in Friday's session. The bounce that we saw in First Republic, well, now they started to sell that, as well as the ongoing concerns about the banking sector. And again, I'm referring to sector as just a group, not the S&P 500 sector. Banks ended up borrowing $11.9 billion from the BTFP, the Bank Term Funding Program. And then also, this is what concerned the market, a record $153 billion from the Fed's discount window with the week ending on Wednesday. And the thing that makes this kind of concerning is that this is even higher than what they had borrowed during the financial crisis back in 2008 into 2009. On an intermediate term basis, we still have our BPI, and that's it right now. No short-term indicators and no other intermediate term indicators. The dollar was down and interest rates were also down. That gave a little bit of support to stocks with interest rates going lower. But this flight to quality that we had been seeing where people are getting out of stocks and over into bonds, that resumed on Friday. So that pushed bond prices up and interest rates down. All of our other yield curves remain inverted, but that 30 to the 5-year has now gone back to being regular instead of inverted. Sentiment has dropped a little bit down to being extreme negative at 25, where it had been just negative at 28. Our trend is negative, but it's starting to weaken. We're dropping below the moving average as the market's chopping around, but we're below 20 overall, so we're not really in a trending environment. Our bias is now negative with the down day, and I've switched our momentum from mixed back down to negative with the down day that we saw in Friday's session. The economic reports that came out, we had industrial production, which came in unchanged on a month-over-month basis. They expected it to be up 0.5%. Last time it was up 0.3%. Capacity utilization came in at 78. They expected it to be at 78.5. Last time it did come in at 78. The leading economic indicators came in down 0.3%. They expected it to be down 0.4%. It's a little bit better than expected. Last time it came in at down 0.3%. Then the Consumer Sentiment Index, it dropped a little bit. This is the preliminary reading. We'll get the final reading next Friday. It came in at 63.4. They expected it to be higher than that at 67.2. Last time it came in at 67. And a year ago, it was at 59.4. So it's improved a little bit, but none of these numbers are much to brag about. People are just not happy with what's going on. Just to give another update as to where we stand with interest rates, on March 3rd, that was a Friday, we had a 71.6% chance that we will be up 25 basis points. Then Fed Chair Powell came out and spoke. Then it jumped up to 50. Now it's dropped back down to 25 basis points. But it's dropping a little bit, and you have this increasing where they may leave rates unchanged. If we get more bad banking news, this percentage of leaving rates unchanged will probably go up, and raising them 25 basis points will continue to go down. So the Fed's kind of in a corner right now with what to do. They can't really raise interest rates when we're having financial difficulties, but yet there's inflation at the same time. Here's the consumer sentiment where it did tick down to 63.4. We compare this to the 2-year Treasury yield, which is also falling, but there's still a really wide spread between the two. The Ulster Index is above the moving average and climbing, showing a little bit more fear in the market. Here's the VIX, where it spiked back up, both on the line chart and on the bar chart, so it's getting to a higher level now, where volatility of the VIX is starting to pick up as well. The equity put-call ratio declined a little bit on the latest reading, but what we're paying attention to is the 5-period simple moving average, which is also declining, but we had a spike up here above 0.8, and now it's starting to come back down. If we go up, that could give some support to the S&P 500. On a one-day basis, we probably overdid it. Our advanced decline ratio was extreme negative. Our trend shows the ADX is rolling over and going below the moving average. We still default to negative with the red line on top, even though it's declining, but now the green line is also declining. The daily chart shows that we're still above this trend line, but we broke down below the 200-day simple moving average again. And then down here, you can see where volume really spiked up because of quadruple witching. Here's the 2-year look at that same chart, where we're still maintaining prices above this downward sloping trend line. The Arum was pretty much flat from Thursday to Friday. It's still negative overall after giving us an extreme negative reading. In our short-term stochastics, it's negative. It's below 50. Same thing, even though it's rolling over with the intermediate term. And we're coming out of an extreme negative reading with our longer-term stochastic. The force index, which blipped back above the zero line after Thursday, it's now fallen back below zero. That's negative in the short term. We're still seeing some upper resistance with the 20-period simple moving average, where prices are coming up to that level and then going back down. The 100-period moving average, we're now dropping below both of those, the simple and the exponential moving averages. And we're coming down to the underside of the moving average tree. The slope is still going up overall. This is one of our faster oscillators. It is more reactive to price action. It's still picking up on what happened in Thursday's session and hasn't really calculated Friday's session, at least yet. And here's all of our oscillators. The slope is the only one going up. The TSI is showing some improvement, but it hasn't crossed yet. The MACD is showing some improvement. The PMO and the PPO, they're turning up, but they haven't crossed positive yet, with our longer-term oscillators still headed down. Parabolic SAR continues to be negative with the dots on top. Chaikin oscillator, after coming above zero and looking more positive, now it's started to tick back down. It's still positive, but showing weakness. The PMO study, we're no longer extreme negative with the PMOs that are rising. The buy signals are just coming out of an extreme negative reading, and we're still declining with the PMOs that are above zero. Bullish percent index, we're still dropped down below 30, so that is extreme negative. It does have a lot more room to fall, but we'll have to see if things stabilize here and then start to go back up. NYSE bullish percent index ticked up just slightly, but still continues to fall. This is a broader measure. Chaikin money flow still showing some improvement. This attempts to measure what are the big institutions doing. When this is going up, they're thought to be buying. When this is going down, they're selling, and we're still seeing this going up slightly. It's still negative, but showing some improvement. Balance of power right about on the dash line. We ticked a little bit above it after Thursday. Now we're just down below it after Friday. TTM squeeze still showing some improvement here. It's still negative, but we have the lighter shade of red bars for the histogram. The go-no-go system is still in a neutral set of purple signals after giving us a negative signal. The anchored moving average going back to the COVID low still seems to be holding up as support. and we're now dropping down below the 200-day simple moving average. Our shorter-term fib levels, we closed just above this shorter-term fib level. We have some additional support at about the 39.82 level if we continue to fall, and then the next level of support below that would be at 38.08, and that's a double fib level, which held up as support earlier in the week. We'll have to see if we come back down to test this. Longer term, we're still in no man's land with 40.20 on the upside and 39.26 on the downside. The elder impulse system for the S&P has switched back to neutral. The McClellan oscillator is declining and not extreme negative. The same thing is true with the NYSE McClellan oscillator. The summation index based on price and volume continue to decline. New highs, new lows also declining with our 5-period and with our 10-period moving average. And we saw a big bit of down volume. So the advanced decline line, which had been looking a little bit better, is now showing a decline based on price and especially on volume. Accumulation distribution, it's still positive, but showing some weakness as we're above this moving average. Volume is really starting to pick up, and the ratio between the financials and the S&P 500 still continues to show a lot more weakness. The bank sector, after bouncing up on Thursday, is now starting to go back down. Looking at the regional banks, also got hit and are starting to go back down. Here's another regional banking ETF also showing some weakness. Here's the ratio between regional banking and the financial sector, where it's now continuing its downward decline. And here's the First Republic Bank. This has been in the news lately. This idea of these private banks going in and giving them money to help them get through this storm. This stock has just been getting hammered a lot. It was around the 115 level just a couple of days ago. Now it's dropped all the way down to 23. The ratio between the S&P 500 and the equal weight index still shows that the bigger stocks are holding up better and are really outperforming. And this could be a positive backdrop. The Dow closed down below this support level at S1, and we're still below the 50 and 200-day moving averages. The diamonds continue to be neutral. The Nasdaq, which is trying to give us a golden cross here, has stalled out right at about this pivot level and has been coming back down, but holding up a lot better than the rest of the market. The NASDAQ 100 did give us a recent golden cross, but also stalled out at this R1 level. The Qs remain positive, and the small caps, which just got hammered earlier in the week, they were down again in Friday's session. There's the Russell 2000 small cap index, where we're still hanging on to this support level. So far that's positive that it's holding on to that, but if we break down below it, that could really accelerate things to the downside. The RSI 9 is starting to go extreme negative, and the MACD on the bottom continues to be negative. The Elder Impulse system has the small caps at negative with a new red bar, and the ratio between the small caps and the S&P continue to decline. The mid caps also been getting hit hard, and the Elder Impulse system has switched back to negative. The home builders were declining with the S&P and with the home builders. The ratio is starting to go down, and now the relationship's starting to get a little bit stronger now. So this positive divergence that we were looking for hasn't happened yet. We'll keep watching this to see if that does develop. The Copic curve is trying to give us a buy signal, so that is positive. And the relationship between stocks and bonds still have a pretty strong tendency to go in opposite directions. Bonds are going up and stocks are going down. Here's the bond yield. Just a few days ago, after being above 4%, is now falling down to 3.4%. And here's the price of bonds are really spiking up as we see more of this flight to safety. And the fear gauge still starting to tick back up, showing that there's an increase in fear in the market. Looking at the long term, we're rolling over with the MACD now. So we have to assume that this breakout ended up being a fake out. Doesn't mean that all is lost yet. We could still bounce back up. We're maintaining price right above this downward sloping trend line. But if we see more weakness and then close below this trend line, that will be more negative. Looking at our possible positive scenarios, this is a positive backdrop. The Qs are still really outperforming. We're seeing some improvement with discretionary, and large cap growth is outperforming large cap value. And then our growth value ratios showing large caps, mid caps, and small caps are really going higher. So this could give some positive backdrop to the market if we get to the point where we can sustain more than one up day. Looking at the broad range of the highs minus the lows and then taking a 5-period moving average, we're dropping below zero, and that is still declining even further. This is also turning negative. Our 50-period exponential moving average of the new highs minus the new lows is dropping below the zero line. And then our indicator is well below zero and showing an increase in the decline. The 2-year Treasury yield, after really spiking up, is now coming back down. We're waiting to see. Will that give some support to stocks? So far, it hasn't been doing that. And then our staples to S&P 500 ratio came back down just slightly. We're still working off of this spike, but we're not seeing a real follow-through in price more than what we've already seen. What's our outlook for Monday? The technicals are just flat out negative, not extreme positive or negative. We don't have any economic reports coming out on Monday, and then the whole list of geopolitical events. We'll see if anything else develops over the weekend concerning this banking problem. It looked like it was starting to go away a little bit, but now it's coming back. We'll see if there's any additional information that comes out. The stock trader almanac statistics, the Dow is neutral to positive, where the S&P is more neutral to negative, but the NASDAQ is more positive, with 66.7% of the time being up. And then all the other things that are adding to this positive backdrop, but we're just not seeing the follow through based on price yet. Here is trading day number 14, where we do have a slight tendency to be up with the S&P 500. That's the green dashed line. And then our scenarios. You could go with the down one, although we're not trending. So be very careful of that if you decide to short the market. But our technicals are negative. We can't go with the up one because we are negative and we're not trending. So we're still defaulting to the sideways trend, even though our ADX is weakening. It's below 20, but the red line's on top, so it is negative. Our conclusion, the S&P is negative, short-term negative, intermediate-term negative. We've switched back to long-term negative because we dropped below the 200-day simple moving average, even though we had a recent golden cross. Thank you. I hope you found this helpful. I will be preparing and posting the weekly video, the intermarket analysis video, the deep dive video, and the supplemental video between the time you look at this and before the market opens for Monday's session. Have a great weekend, and I will talk to you in the next video.